Tonight, 3 rental plays just exposed a truth most people miss. You don't get rich by buying a rental. You get rich by buying the right kind of rental at the moment the market is asleep. One filthy lake-adjacent wreck that looked unlivable. One brand new house bought under replacement cost while builders were sweating. One tiny city lot that quietly hides a second payday in the backyard. Same year, same market mood. 3 totally different roads to wealth. You're here with us on this channel. Let's move. Here's the core idea we're going to keep coming back to. Rentals don't make you rich because they're rentals. They make you rich because they solve a problem for somebody and we capture the spread. We're not gambling, we're measuring. And when we measure correctly, we get options. Cash flow, appreciation, tax advantages, or clean exit when the numbers stop behaving. Now watch this, because most people are trained to look at one thing. Purchase price, cheap must be good. Expensive must be bad. That mindset is how you buy a deal that becomes a 5-year headache. We care about 3 things: demand that doesn't quit, a plan that survives surprises, and an exit that doesn't require luck. Let's start with what looks like a joke on paper. A small house near a lake, priced like a used car. The kind of place your friends would drive past and laugh at. The kind of place where the floor feels like a trampoline and the air feels alive. Not in the good way. The first time you step inside, it's not cozy. It's chaos. Rotten subfloor. Heavy smell. Layers of grime. And yes, creatures that clearly believe they owned the property before we did. This is where people either run or they get paid. Because the ugliest houses have a superpower. They scare away competition. And when competition disappears, pricing becomes negotiable. That's the real discount. The discount isn't the sticker price. The discount is the silence. No other buyers fighting you. But we don't buy ugly just to be brave. We buy ugly when the upside is obvious and the downside is containable. So what makes a wreck across from a lake interesting? Location that sells itself. Not downtown hype. Not future development. Real immediate demand. Water. Views. Weekend traffic. People with families looking for a quick escape. People who don't want a 5-hour drive, they want a Friday night reset. Now here's the trap. A lot of investors hear lake and immediately daydream about short-term rental income. They jump straight to $3,000 a month in their head. They buy first, plan later. And then they learn the hard way that a lake doesn't fix bad numbers. We do it the other way. We buy when we can survive on the boring plan. If this property only performed as a long-term rental, could it still work? That's the first stress test. Because if the short-term market softens, or regulations tighten, or seasonality punches you in the face, we still need the deal alive. So we set 3 lanes. Lane 1 is the clean flip, renovate, sell, take profit, move on. This is for when the market gives you a fat gap between what you can buy at and what the neighborhood actually sells. This is for once it's livable. Lane 2 is long-term rent. Stable tenant, predictable income, fewer surprises. It's not sexy, but it's durable. It's the kind of plan that keeps the lights on while your other projects take longer than expected. Lane 3 is short-term or medium-term rent, the premium lane, the one that turns location into income, but only if the property is designed for it, and only if you can protect the operation. And here's the kicker. When you have 3 lanes, you stop being desperate. Desperation is what kills investors. Desperation makes you accept bad contractors, bad terms, and bad tenants. Options make you patient. Patient investors win. So we pick up the wreck, not because it's cute, because it's mispriced. But we still have to talk about the part nobody glamorizes, the rehab. A lot of people think rehab is painting in a backsplash. No. Real rehab is a control system. It's budget discipline. It's scope management. It's not over-renovating. And it's also not under-renovating and pretending the market won't notice. Because the market always notices. The first move is safety and structure. If the floor is compromised, nothing else matters. You don't install nice countertops over a collapsing foundation. You fix the bones. Then we remove what scares normal humans. Smells, stains, bugs. Anything that makes a guest hesitate at the doorway. Because hesitation kills bookings and tenants. Then we add the upgrades that create revenue, not the upgrades that create applause. Here's the mistake most people make. They renovate for their ego. They build what they would want if they lived there. That's expensive and it doesn't always pay. We renovate for the renter's decision. For a lake property, the decision is made in seconds. Photos, light, clean lines, a simple wow factor, and 1 or 2 features that create, I need to book this energy. And yes, sometimes that feature is ridiculous. Sometimes it's a game room. Sometimes it's a fire pit with string lights. Sometimes it's a golf simulator or a theater wall. The point isn't the gadget. The point is differentiation. Because short-term rentals are a feed. People scroll. If you look like everyone else, you're invisible. But if you've got the one thing in the market that makes the thumb stop, you can charge more, you can book more, and you can survive price wars. Now, we also protect it. We're not naive. Tech gets broken, people spill things, kids exist. So we build the experience like a business, not like a museum. Lockable storage for sensitive gear, durable materials, spare supplies, a layout that prevents misuse, and rules that are simple enough that guests actually follow them. Now here's the part that separates amateurs from pros, permitting and timelines. A deal can be perfect and still die if the city stalls you. If it takes 9 months to get permission to do basic work, your carrying costs eat the profit. Your contractors disappear. Your interest clock keeps ticking. Suddenly you're not investing, you're bleeding. So we treat permitting like due diligence. Before we buy, we ask, what can we do by right? And what requires permission, hearings, exceptions, or neighbor approvals? If it's standard work, we want speed. Walk in, apply, get it done. If it's non-standard, like building a deck over a driveway or changing parking or expanding in a restricted community, then we price the hassle. We don't assume approvals, we plan for friction. Now the financing. When you buy something that's barely standing, conventional lenders don't want it. They want habitable. They want boxes checked. So we use the financing that matches the asset. Renovation financing, private money, hard money style terms, whatever lets us move fast. The goal isn't cheap money, the goal is control and speed. We'd rather pay a higher rate for a few months and secure a great deal than miss the deal trying to save half a point. Then, when the property is stabilized, clean, renovated, rentable, we refinance into boring long-term debt. That's the shift. You use aggressive money to buy and build, then you replace it with calm money to hold. This is educational. We manage risk. So what's the takeaway from the lake wreck? This rental makes you rich if you have 3 things: a location that creates premium demand, a rehab plan that doesn't spiral, and multiple exits so you never get trapped. Now, before you assume, cool, I'll go buy a disgusting house, let's ask the real question. Why are there investors getting wealthy buying brand new houses that need zero work? Because wealth isn't one strategy. Wealth is repeatable advantage. So let's flip the script. Picture a busy professional, full-time job, kids, deadlines. No time to manage a 5-month rehab. No stomach for surprise plumbing and mold remediation. That person still wants real estate. They still want to build wealth. They just need a different machine. And this is where new construction becomes a weapon, if you buy it correctly. Most people hear new construction and assume overpriced. They assume you're paying a premium. Sometimes you are. But there are moments when builders get stuck. Inventory piles up. Rates squeeze buyers. They need sales to keep their crews moving and their lenders calm. And when that happens, builders start paying you to take the keys. Not with a billboard. Quietly, with concessions, price drops, rate buydowns, closing cost credits, upgrades thrown in like a bribe. And if you understand what you're looking at, you realize something huge. You're not just buying a house, you're buying a cost basis below replacement. If construction costs rise, and they do over time, your property gains a tailwind even if the market is sleepy. The builder can't rebuild it cheaper next year if labor and materials climb. Now the location matters. And here's where people get tricked by headlines. They'll say, this city has inventory. They'll say, prices are falling. And then you zoom in and realize the headline is about the city core. Not the metro, not the suburbs, not the growth corridor where jobs are moving. Cities are not monoliths, neighborhoods are ecosystems. So we look for the path of progress, where businesses are expanding, where infrastructure is pushing out, where families actually want to live because the schools, commute, and lifestyle work. And then we look for a deal that feels almost unfair, a brand new house priced well below the local median, not because it's magic, but because it's in a pocket where builders are competing, or where a specific community has too much inventory, or where a builder just wants to clear a phase and move to the next one. And when we see the price and the rent, we don't just ask, does it cash flow today? We ask if maintenance is low, if vacancy is lower, if the tenant profile is stable, does that quietly outperform the old, bigger cash flow property over 10 years? Because a house that doesn't eat you with repairs is a different kind of profit. It's invisible profit, the kind that shows up as less stress, fewer midnight calls, and a property you can actually hand off to your family without gifting them a constant repair list. Now, rate buydowns. This is the game within the game. When rates are high, payment sensitivity becomes everything. And builders know it. So instead of discounting the price massively, which can hurt their comps, they'll buy down your rate, or they'll offer credits that effectively do it. So you end up with a payment that pencils. And while the internet argues about cash flow versus appreciation, we're quietly stacking a house that's stable in a growth area with a cost basis that's hard to replicate. And yes, the rent might not look like a home run on day one. That's okay. Because we're not chasing adrenaline. We're building a machine. Here's the open loop you need to hold on to. The quiet deals rarely go viral, but they build the portfolios that survive. And survival is what creates compounding. Now we have 2 wealth engines, the ugly premium rental with options, and the new build discount rental with stability. But the third one is where the market hides the biggest pop. Because this is the one that doesn't look like a rental at all. It looks like land. In expensive cities, the house is almost irrelevant. The land is the prize. They're not making more of it. And when zoning allows it, land becomes a lever. So imagine a small, older house on a lot that has a secret door, access from two sides, or an alley, or a layout that makes a second structure possible. Most buyers look at it like a normal home and say, this doesn't cash flow. They're right, if you only see one building. But if the property can host a second unit, or be split, or allow a backyard build, the math changes completely. Suddenly, you have a second asset hiding behind the first. And here's the part that makes this strategy so powerful. You can create cash while you wait. You renovate the front, rent it, or sell it, and that action funds the next move. You're not just sitting on a vacant lot hoping values rise. You're manufacturing the outcome. Now, this is not guessing. This is not, I think I can build back there. That's how you lose six figures. You bring in the pros, surveyor, architect, engineer, someone who knows the zoning and the setbacks and the parking requirements that will make or break your plan. Because one missing parking spot can wipe out your resale value. One wrong assumption can turn your free land into a liability. So we run feasibility before we fall in love, and we design the plan so it survives a cost spike. If build costs jump, can we pivot? Can we sell the front at a profit and walk? Can we sell the back lot as is? Can we hold the property as a rental and wait for the next cycle? Again, options. The smartest investors don't win because they predict the future. They win because their deal still works when the future is rude. Now, the cash flow question. In high-price markets, buying a rental straight often doesn't pencil. Rent doesn't cover the debt, taxes, and insurance. People either give up or they get creative. Creativity is not a gimmick. It's how you squeeze value out of fixed land. You can renovate and sell the front to recover capital. You can build the back to create a second sale or a second rental. You can exchange into a multi-unit later. You can convert the equity into a portfolio. And yes, this can take time. Permits, design, construction. It's a longer game, but the reward is that you turn one expensive property into multiple paydays. So when people ask, how do you build wealth in an expensive market? And this is the answer. You stop buying houses and you start buying problems you can solve with planning. Now let's stitch all three together, because this is where the real lesson sits. We're seeing three rental types that make you rich, and they're rich for different reasons. One is rich because it turns ugliness into equity and premium demand into income. One is rich because it turns builder pressure into a discount and stability into compounding. One is rich because it turns land into leverage and leverage into a portfolio. But here's the question that decides whether this helps you or just entertains you. Which one matches your life? If you've got time and a contractor team you trust, the ugly house can be a rocket. If you've got a demanding schedule and you want low friction, the new build can be the backbone. If you're in a high-price market and you're tired of numbers not penciling, the land play can be the cheat code. And we don't need to pretend one is superior. The superior move is the one you can repeat without burning out. Now, let's talk about the psychological warfare, because rentals test you. The ugly deal tests your patience and your discipline. A rehab will try to expand. Contractors will try to upgrade you. And the budget will whisper, just one more change. That's how you bleed. So we run tight scope. We pick the upgrades that drive revenue. We ignore ego renovations. We track weekly progress. We make decisions fast. The new build tests your ability to ignore noise. People will tell you new builds don't cash flow. People will post charts. People will mock modest returns. But while they argue, we're collecting depreciation, we're collecting rent, and we're holding a property that doesn't collapse at 2 a.m. because a 30-year-old pipe finally quit. The land play tests your planning. It's easy to dream. It's hard to execute. This is where bad assumptions destroy good investors. So we do the boring work early. We confirm zoning, we confirm access, we confirm parking, we confirm setbacks, we confirm timelines, and we price the friction. Now, there's another layer to all of this, the tenant or guest profile. The lake property is an experience. The guest wants a feeling. They want the weekend story. So we build for photos, for comfort, for this is different. The new build rental is a stability play. The tenant wants reliability. They want clean, modern, easy. They want a place that doesn't punish them with surprises. And those tenants tend to stay longer because moving is pain. The land play is about the end buyer or the end renter. If you build a second unit, who is it for? A family, a professional, a multi-gen household? Oh, a roommate setup? We design the product for the demand we can actually capture. That's why we blueprint the renter before we pour concrete. When the crowd buys a house, we buy a business model. And when the market wakes up, these edges vanish. Want our underwriting checklist and the red flags that kill deals? Subscribe. Next video, we run a real deal live and you'll see where people get trapped first.